don't think that's true, but I think more confidence. You'll remember back in 2023 when Kitco viewers were experiencing frustration given that the gold price was up, but the gold mining shares weren't up. That was easy to explain in two fashions. One, the gold price was up because foreign central banks were buying gold and they weren't buying gold shares. So an asset class that had a bid was going up, while one that didn't have a bid was going down. In past bull markets, it has taken a while for the increase in the gold price to follow through to generate increased free cash flow among the gold miners. And that happened in 2024 in spades, and it's happening in 2025 in spades. What that means is that the prices of the gold miners, as an example, Wheaton Precious Metals, who was an exhibitor, Agnico Eagle, who was an exhibitor, those companies are up in the last 18 months uniformly 100 to 150%. And it's follow through, I think, gold to the gold shares that attracted our attendees. The thesis is proven. They don't now have to feel like they have to wait for a gold bull market. They understand that they're in a precious metals bull market and that they're in it right now. I think that's true. And you mentioned the Newmont quarter. I mean, that blew out everybody's earnings estimates, including my own. And frankly, it blew out Newmont's own estimates. What Newmont did, and we talked about this, Jeremy, you and I, a year ago. Newmont had, prior to this quarter, 8 bad quarters in terms of sustaining cost performance. What Newmont did is they sold off virtually all of their second-tier assets. By the way, raising almost $5 billion in the process. But the other thing they did is free up management time and attention and sustaining capital to focus on their tier 1 projects. And the operating cost performance was absolutely spectacular. In addition to that, they added almost $5 billion in cash to the balance sheet. They can deploy some of this for sustaining capital, but they can also give some back to shareholders, which they've elected to do. They've decided that they're going to buy in stock, returning cash to shareholders by reducing the float. Spectacular result. And that has, that's the wealth has been spread around. With people like Dakota, the market is looking at the Barricks of the world, at the Newmonts of the world, and saying, what are they going to do with all this money? What are they going to do with all this high share price? How are they going to maintain their growth? Maybe they're going to. I would suspect both of those. That's a great comment. For the viewers who aren't familiar with this statistic, in the period 2000 to 2010, when the gold price went up 7-fold, the free cash flow per share of the gold miners actually declined. It was a decade of ridiculous malinvestment of capital. The management teams that presided over that dismal performance, have been thanked and excused. But the institutional investors and the management teams themselves have kept the mining companies on a very tight leash with regards to capital deployment. My suspicion is that as the metrics around gold companies' valuations increase in a bull market, and as investor concern about companies' ability to maintain or grow their production increases, then you will see increased investment activity, including increased merger and acquisition activity. So I think what you describe as the calm before the storm is completely accurate. My attendees to focused on the best names, the best of the best, the Agnicos of the world, the Francos, the Wheatons, give you surprising performance in a gold bull market with almost no operational risk. For myself, I bought those names 4 years ago and 5 years ago, so I don't have to buy them now. What I'm doing now is coming down the quality trail, looking for big single mine companies that would make attractive bolt-on acquisitions, and ones that are cheap. I need to mention too, Jeremy, that I'm much more willing than most to accept political risk. So names like West African Resources in Africa, Endeavour Mining in Africa are appealing to me because I'm willing to take political risk and because they're extremely cheap by any metric. I personally, too, am going down into the exploration space because I like to be involved in markets where I don't have much company and very much competition. I wouldn't expect the bull market to expand into the exploration space per se for 18 to 24 months. But I like to be in space before the competition.
You know, one of the things I've tried to remind people over and over, sometimes until they roll their eyes, is that markets are ultimately about confidence. When confidence goes away, nothing else matters. That's as true in the resource space as it is anywhere else. In fact, I would argue that resource stocks amplify whatever mood the market is in. When confidence is high, they levitate. When it's low, they get cratered. And if you've been around this business long enough, as I have, you learn not to confuse volatility with risk. Volatility is just part of the ride. Risk is what happens when you don't understand what you own. Let's start with something fresh in people's memories. Back in 2023, Kitco viewers were pulling their hair out. The gold price was strong. Foreign central banks were buying hand over fist, but the gold miners weren't keeping up. And I got a lot of questions. Rick, how can this be? Isn't this supposed to be a bull market? And the answer was simple. Foreign central banks don't buy equities. They buy bullion. They wanted the real thing, not a proxy. So you had an asset class with a strong bid, gold itself rising, while the equities languished because they didn't have a bid. That's the kind of nuance people often miss. But then something happened. The higher gold price, sustained over time, began to feed through the income statements of the miners. And by 2024, it was showing up in spades. Suddenly, the free cash flow was undeniable. Dividends were being raised, balance sheets were cleaned up, and the equities began to catch up. By 2025, companies like Wheaton Precious Metals, Agnico Eagle, and Newmont were delivering 100% to 150% gains in their share prices. This wasn't a meme stock sugar high. This was follow-through. Real cash, real earnings, real operating discipline. Newmont is a case in point. For 8 straight quarters, their sustaining costs were ugly. They were, frankly, an embarrassment. But then they did something smart. They sold off their second-tier assets, almost $5 billion worth. They raised cash, but more importantly, they freed up management time and sustaining capital to focus on their Tier 1 projects. And the results were spectacular. They blew out their own estimates. They blew out the street's estimates. And with that cash hoard, they started buying back stock, returning money to shareholders, and showing real discipline. For a company that had been on the naughty list for years, that was a remarkable turnaround. And that, folks, is what attracts institutions. It's not a promise. It's not a PowerPoint slide with a world-class deposit. It's cash on the barrelhead. Now, I need to pause here and remind everyone of a painful decade. From 2000 to 2010, the gold price went up sevenfold. Sevenfold! But the free cash flow per share of the gold miners actually went down. Wrap your head around that. An entire sector managed to destroy value in the greatest bull market of their commodity in a generation. Why? Ridiculous malinvestment. Management teams couldn't resist chasing ounces at any cost. They blew shareholder capital on marginal projects. They assumed that higher prices would bail them out, and they were wrong. Shareholders paid the price. The good news? Those management teams are gone. The survivors have been thanked and excused, to use a polite phrase. And the institutions haven't forgotten the lesson. They've kept the industry on a very tight leash. You don't get a blank check anymore. You get measured on return on capital. And that's a good thing. It forces discipline. It forces prudence. And in a bull market, it means that the cash actually accrues to shareholders instead of vanishing into a black hole of growth for growth's sake. That brings us to the setup today. We're in a precious metals bull market, not just a gold bull market. That distinction matters. In a gold bull market, you're always waiting for the price to move. In a precious metals bull market, the thesis is proven. The wind is at your back. You don't have to hope anymore. You just have to participate intelligently.
In my experience, Jeremy, precious metals bull markets are led by gold. They're led by the fear buyer. They get kicked off because savers and investors are concerned about the deterioration of the purchasing power of domestic currencies, fiat currencies, in regular savings products. Gold moves first. When the move in gold allows producer margins to expand, the senior gold stocks move next, which is what we've just seen. Mm-hmm. At some point in time, the momentum in both gold and gold stocks attracts the generalist investor into the precious metal space. When that happens, perhaps because of its lower unit cost, leadership goes from gold to silver. I've watched this happen 3 times before in my life, and Jeremy, believe me, you will not need Rick Rule to tell you when it occurs.
Mhm.
Silver is incredibly volatile, both to the upside and the downside. It's the upside that comes next. As to a squeeze, I think the squeeze comes about, if it comes about, because the trading volume in the futures market is so extraordinary relative to the amount of gold available for good delivery in the physicals market. Many days, single days, the trading market trades 200 times the amount of silver
Mhm.
available for good delivery on the market. The potential for a fairly small number of the futures contracts to hold for delivery and the impact of what that would have on physically available supply could be dramatic. We need to differentiate between the squeeze that we'll likely see and the squeeze we won't see.
Yeah.
There are some silver bugs who suggest that there will be no silver available, and as a consequence of that, there will be the mother of all short squeezes on the futures market. That won't happen. Silver futures markets are owned and made by the dealers, by the banks. What will happen in the event that there is a temporary unavailable of metal is that the markets will suspend the contracts and cash settle. That's what will happen.
Hmm.
This will be extremely pleasant for the people who are long and extremely unpleasant for the people who are short. But it won't be the sort of incurable market imbalance that many of the silver bulls dare dream for. The physical holder probably in percentage wise benefits the least. The leveraged futures holder maybe more. The silver producer a lot. But the answer to that is yes, yes, and yes. And of course, the penalty is borne by those who didn't participate or heaven help them,
Yeah.
those who were. There is a real shortage
Yeah.
of decent quality silver companies, and that's been noted in three prior bull markets. My friend Doug Casey described the circumstance where the generalist investor money comes in the silver equity space as trying to siphon Hoover Dam through a garden hose. There just aren't enough. And the big silver names are becoming less silver centric. The go-to name in the last bull market was, of course, Ross Beatty's entry, Silver Standard, where over 50% of revenues are now gold revenues. There is still a silver constituency. For those people who would like equity vehicles that are very responsive to the silver price. Traditionally, those include Core Mining, Hecla, and First Majestic Silver. For people who want really high quality silver names that are maybe less correlated to the silver market, one likely needs to look south of the border. One looks to Fresnillo, one looks to Peñoles, one looks to Buenaventura. Among the juniors, we had a great list at the conference. We had Aya Gold and Silver, a great small producer. We had Vizsla Silver. We had Abra Silver. Very, very, very small, but list of very high quality discoveries.
When we left off, I was making the point that this is not merely a gold bull market. It's a precious metals bull market with stronger companies and a healthier setup than anything we've seen in decades. But let's expand on what that means in practice. Because it's easy to wave your hands and say, bull market. It's another thing entirely to understand how it ripples through the sector and how investors can position themselves without getting caught in the inevitable hype and heartbreak cycles that define resource speculation. Let's start with the majors again, because that's where the institutions begin. Companies like Barrick, Newmont, Wheaton, Agnico, these are the names that pension funds, sovereign wealth funds, and big generalist institutions can actually buy in size. The market knows it, the management knows it, and the balance sheets prove it. These aren't your grandfather's gold miners. They're disciplined, focused, and they've had a decade of humility beaten into them after blowing up shareholder capital in the 2000s. That humility, coupled with a higher gold price, is why their free cash flow numbers are now extraordinary. And remember, cash flow is what eventually drives share prices, not PowerPoint decks. But what happens next is predictable, because I've seen this movie before. As the majors get flush with cash and their share prices rise, the market starts asking, how will they replace their ounces? How will they grow? That pressure, whether spoken or not, pushes them toward mergers and acquisitions. They can either return all their cash to shareholders, or they can deploy some of it into growth. And because exploration is high risk, slow and uncertain, they often take the faster route. They buy growth. That's where the single mine producers and quality developers come in. That's why I'm looking at West African Resources, Endeavor, and similar names. They're potential bolt-on acquisitions. They're digestible, they're accretive, and in a bull market, they can be bought at prices that still make sense because they're trading cheap relative to the majors. Now here's where political risk enters the conversation. Most Western investors won't touch Africa. They hear the word Burkina Faso or Côte d'Ivoire, and they break out in hives. And to be fair, there are real risks: coups, corruption, local community disputes. But here's the thing, the rocks don't care about borders. Geology doesn't read the Financial Times. Some of the richest deposits in the world are in places that scare investors. If you're willing to accept that political risk, size it appropriately, and understand that you're being paid for that risk through lower valuations, then you can capture extraordinary returns. I'll never forget being laughed at years ago for suggesting that some of the best opportunities were in Africa. The same people laughing back then are now chasing those same names at 3 times the price. That's how markets work. One of the tweets that caught my eye recently said, "Investing is simple. Buy when it feels terrifying. Sell when it feels obvious. Repeat." That's good advice in resource stocks. If you're comfortable, you're probably overpaying. If you're nauseous, you might be onto something. The problem is, most people can't live with discomfort. They want certainty, and certainty in this sector always comes with a price tag. Now let's go down another layer into the exploration space. This is where fortunes are made and lost. And let me be clear, most explorers are value destroyers. They never find anything. They spend shareholder money drilling holes in the ground and then raise more money to drill more holes. 90% of them will never amount to anything. But the 10% that hit can deliver life-changing gains. And in a bull market, the 3% that actually become mines can deliver generational wealth. That's why I love this space, even though it's lonely right now. The institutions aren't here yet. The ETFs don't own these names. The Robinhood crowd doesn't even know they exist, but they will. Give it 18 to 24 months, and they'll be chasing them like lemmings. By then, I want to be positioned. That's how you turn 10-cent shares into $2 shares. But you need the patience to sit through dead money while you wait. Now let's zoom out and connect this to the macro picture. Because you can't talk about resource stocks in a vacuum. They're driven by liquidity, by sentiment, and by global trends. And the global backdrop right now is one of extraordinary instability. Central banks are trapped, debt levels are unsustainable, inflation is sticky, geopolitics are combustible, and confidence is fragile. In that environment, real assets, things you can't print, become the refuge. Gold, silver, copper, oil, agriculture. These are the foundations of civilization. You can't run a data center without copper. You can't build solar panels without silver. You can't fight a war without oil. You can't eat without grains. That's why commodities, broadly, are entering another bull phase. Take silver as an example. It's money, yes, but it's also an industrial metal, and the demand from solar panels, electronics, and energy transition technologies is exploding. Supply, meanwhile, is constrained. The majors don't want to build new mines because they still remember the scars of the last bust. The result? A squeeze. And when silver squeezes, it doesn't move politely. It doesn't climb a staircase. It leaps an elevator shaft. That's why I tell people, if you're going to own one wild card in your portfolio, make it silver. It'll make you tear your hair out, but it will also surprise you to the upside in ways that gold rarely does. And let's not forget geopolitics. Russia, for instance, has made it clear that it wants to establish its own domestic price benchmarks for gold, independent of the LBMA. They're launching trading on the St. Petersburg Stock Exchange, Petersburg International Mercantile Exchange, with kilo bars and 12 kilo bars, and only miners, refiners, banks, and industrial users allowed. The stated goal? To form national price indicators based on true supply and demand in Russia, not Western benchmarks. That's a shot across the bow. It's part of a broader move by the BRICS countries to reduce reliance on Western financial infrastructure. And if they succeed, it undermines the paper dominance of COMEX and LBMA. Imagine a world where gold and silver prices are set not by leveraged futures traders in New York and London, but by physical supply and demand in Shanghai, Moscow, and Mumbai. That's the direction we're heading. And when that shift accelerates, the distortions of the past 30 years will begin to unwind violently. Let me lighten it up with a story. Years ago, I told an audience that mining equities are like a call option on steroids. They have no expiration date, but they can still go to zero. One guy came up afterward and said, "Rick, that's the scariest sales pitch I've ever heard." And I said, "Good. At least you were listening." That's the reality. These are risky businesses. Mines blow up. Governments change the rules. Commodity prices crash. But when the cycle turns, the returns can be spectacular. The key is to size your bets, diversify your risks, and never ever confuse luck with genius. We also need to talk about institutions. They are coming back into this space. They can smell the free cash flow. They can see the balance sheets, and they need exposure to real assets. Pension funds can't afford another lost decade in bonds. Sovereign wealth funds can't ignore the debasement of fiat. They have to put capital somewhere, and commodities are underowned, underloved, and undervalued. When that capital flows, it won't trickle. It'll gush, and it'll lift everything from the majors down to the explorers. That's when the mania phase begins. We're not there yet, but we will be.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.